So I think there's no doubt that inflation is coming off the top. What matters is what's the longer term outlook for inflation. And I think that the picture there is a lot less favorable. We really believe that there are very structural dynamics taking place that are driving inflation. And at some point, the knock-on effects of the raised interest rates hit the economy if we're trying to suffocate inflation. And I think it's probably inevitable that 2024 is a recessionary year. And I think that calm is the period that we should be using to restructure our portfolios for the longer term reality.
Hello everyone, welcome to SFC Markets and Finance.
In its final meeting of 2022, the Fed just raised its benchmark rate by 0.5 percentage point as expected, continuing its battle against inflation. Where exactly is the US inflation heading? Are investors prepared for the world where the interest rate stays higher for longer? Will recession occur in 2023? With those questions in mind,
let's welcome Barry Gill, Head of Investments of UBS Asset Management, to join our discussion. Hello, Ms. Gill. Glad to see you. First, we see US inflation close to lowest level since January in October. And some analysts note that service rather goods will be a main driver of core CPI. So what's your take, and where exactly is inflation heading?
Yeah, so look, I think that there are cyclical and structural dynamics to the inflation picture. And I think there's lots of evidence that cyclically inflation is slowing. You can see it in what's happening with the supply chain, for example. A lot of those bottlenecks are clearing up. You can see it in what's happened to oil prices of late. So I think there's no doubt that inflation is coming off the top. What matters is what's the longer term outlook for inflation. And I think that the picture there is a lot less favorable. We really believe that there are very structural dynamics taking place that are driving inflation, most notably the demographic. Maybe there's 6 factors, effectively: demographics, politics, monetary policy, fiscal policy, supply chain, and then geopolitics. And all of these are converging in such a way that we really think that inflation is going to be the dominant characteristic of the markets for the next many years, albeit punctuated by a probable recession at some point. But from an investor's perspective, we spent 20 years focused on growth, and I think we're going to spend the next long period focused on inflation as a threat.
Some concern about the tight US labor market driving strong wage growth. In fact, based on the most recent job report, the unemployment rate held steady at a low 3.7%. What are your views on US labor market and the risk of wage price spiral?
Yeah, so you have this very, very unusual situation in the US whereby the number of jobs being posted versus the supply of labor is as wide a gap since about 1973, 1974. I mean, it's pretty extraordinary. And it's that dynamic specifically that has led to a lot of the wage-based price pressure that we've seen, particularly since the start of 2021. So there's no doubt that is coming off the top. I don't think that there is a danger in the near term of a wage price spiral, as you refer to it. But the amount that it can cool is very dependent on myriad factors. The US economy itself will cool somewhat, but the global economy may not cool in the way that people anticipate. We just don't know at this point what's going to happen. There's also a huge amount of money still sitting in US consumer wallets from the stimulus that came through from the COVID period. And we don't know how people are going to spend that. Are they going to continue to spend it down and get back to normal savings rates? Or are they going to use it as a buffer? We just don't know. that being said, from a longer term perspective, and if you just look back over the last 40 years, returns to capital have been steadily beating returns to labor. If you think about the overall rents that are available in the economic pie, the return to capital has been going up structurally and the return to labor has been going down. And I think we're at a breaking point in that regard, and labor is going to structurally be taking more share of the economic pie going forward. And I think that's going to lead to long-term stickiness in inflation. And these are the demographic dynamics that I was referring to. And so not nervous about a wage price spiral in the near term, but much more concerned about much more persistent wage inflation over the long term.
Do you say interest rate hikes are starting to have actual impact on U.S. economy? And will the Fed be more concerned at this point about the economic cost, or the Fed officials are still going to keep their collective foot on the brake for now?
So I think the knock-on impact from the rate hikes so far has been very marginal on the economy. And that's because we've gone from what was a very stimulative rate environment to something that's a lot more neutral. And if you think about even where rates are today relative to inflation, we're still at effectively, in the short term, negative real rates. So we're not at the point whereby money is tight. Also, when the Fed starts raising rates, there is a many-month lag between when they start doing that and how that shows up in the economy. So as the Fed moves to whatever its terminal rate level is in this cycle, we will have a knock-on effect on the economy probably at that time. And I think we're just getting some discovery in the markets at the moment with certain dynamics that have taken place. You can kind of get this sense that liquidity is starting to impact the markets, even if it's not impacting the economy per se. The war against inflation was a hard-won battle by the Fed in the early 1980s by Paul Volcker. But I think that the Fed really wants to establish its inflation-fighting credibility again. And remember, we've been in a very unusual period for a long time. And I think that they are going to sacrifice the economy for it. Remember, the Fed has a dual obligation. It wants stable pricing and it wants full employment. But I think their reputation is somewhat on the line. And as a result, they're going to focus on inflation rather than the health of the economy. And the big question as a result of that is, what happens if they do tip the economy into recession? So it's a very, very interesting point in history.
You mentioned that the Fed really wants to establish its inflation-fighting credibility. How difficult is that for the Fed based on what we have seen?
It's a long time since we've seen sequential 75 basis point moves. So they really are trying to stamp their authority on it. But I think this is also in recognition of the fact that they are late. So if you go back to the 2003-2004 rate cycle, it was 25 basis points every meeting for a really long time because they felt they had time. The movements that they have at the moment indicate that they feel that they are late, that they don't have time, and that it's a reaction. And the question is, we don't know the sort of break-even point whereby rates go to the right amount and the economy doesn't fall over, and they are able to tame inflation at the same level. We just don't know what the right terminal Fed funds rate is to do that. I think, and this is sort of a little bit of a guessing game that the Fed is in. And remember, the economy is an incredibly complex beast, and the rate tool is an incredibly blunt instrument. But that, along with all of the QE activity that they've been engaged in over the last many years, these are really the only tools that they have. And so I think that they're trying to do the right things, but they're very, very focused on this. But I think as rates go, into the 4s and maybe into the 5s, there's going to be a lot more internal debate within the Fed as to what that terminal rate level should be.
So we see the Fed acknowledge its significant uncertainty about where the terminal rate would land. And that's probably on the top of everyone's mind as well. What's your prediction? And do you think the Fed is doing enough?
You know, I was asked this question when I was in Australia in September by a correspondent where I thought Fed funds would top out. And I said, I think it has to be somewhere north of 5%. And frankly, I haven't seen any data so far that suggests that it's right to change that view. And I think at the time I was saying that the expectations were that the Fed funds terminal rate would be in and around 4.25%. The broad consensus now is that it's something around 5%. I think that that's probably the right equilibrium, but it's going to be data dependent. And at the moment, you have a variety of things going on in the market that would suggest, and again, this is if the market is a good discounting mechanism, you have a lot of things coming off the top here, which may mean that you don't need to go to 6, and that somewhere in the low 5s is the right level. But I certainly don't see any data points, any evidence at the moment to suggest that they should stop anywhere short of 5.
The Fed staff economists briefed policymakers that the chances of U.S. recession next year had raised to almost 50%. What is your forecast for U.S. economy in 2023?
So I think it's always important to realize that in any given year, the probability of a recession is sort of 20%, right? If you think of about a normal economic cycle, and I know cycles have been elongated over the last 20-odd year period. I'd say my baseline would be that there is no recession in 2023, because I think that consumers have a sufficient excess savings buffer that they will continue to draw down. And as they draw that down, they will keep overall economic activity relatively healthy. I would be more concerned, and I think the probability of a recession taking place in 2024 is significantly higher, because at some point we exhaust that excess saving. And at some point, the knock-on effects of the raised interest rates hit the economy if we're trying to suffocate inflation. And I think it's probably inevitable that 2024 is a recessionary year. But I think it's very hard to forecast the exact timing of these things, and frankly, the nature of the recession. Will it be deep? Will it be middling? I just don't think we know. So I think it's very difficult to predict. I'm not surprised that the Fed staff is raising its forecasts, but forecasting is peering into the dark, and it's hard to do.
Are investors prepared for a world where inflation stays significantly higher?
Look, I think we investors get accustomed to an investing climate. And the investing climate that we have been in has been one of bountiful liquidity for a very long period of time. And it has been persistent for so long that one could conclude that it is permanent. But we know that the investing regimes change over time. And so the question is, are investors prepared for a world where inflation is significantly higher? What happens? What are the signals that we're going to get from the market that as if inflation stays high, the cost of capital stays high, what marginal activities in the economy are going to get exposed? Very recently in the UK, we saw what was going on in the liability-driven investment framework, the LDI, where you had this massive spike in gilt rates, and it caused all sorts of pain for pension funds. We've seen a collapse of a crypto exchange, clearly at the fringe of what's going on in the broad economy. But these are all interconnected with the overall tightening of the cost of capital. And I think going back to your earlier question in terms of when is this going to show up, how is this going to manifest itself, we don't know. but we just know that what we have to prepare ourselves for is that the investing environment is going to be structurally different. And the question is, how quickly do investors realize that this is a long-term change in the climate, and how quickly do they position their portfolios for it? And I think that's going to drive a lot of some elements of volatility and a lot of repositioning in the markets over the next months and quarters.
So what is your view on risk assets? Is next year still going to be difficult for investors?
What we had this year was quite unusual. Certainly if you're a developed market investor, you had bonds go down and you had stocks go down. It doesn't really happen very often. So investors are hoping, and it's quite possible that if we go back to the base sort of forecast that we were talking about, that bonds and stocks volatility could go down for some period, and bonds and stocks could sort of be more inversely correlated going forward. I just don't think that that is the thing to focus on. I think that calm is the period that we should be using to restructure our portfolios for the longer term reality. So picking up on my answer to your prior question, the tide is likely going out, right, and staying out, and that's going to have a knock-on effect on markets. The financial markets are enormously complex and intertwined. And I'll just give you one analogy. I remember spent a lot of time in 2004, 5, 6, 7 thinking about the subprime housing market and what was going on there. And I really felt that I had figured that out. And what I failed to understand was when the liquidity came out, I was focused on one component of the economy, and I didn't understand what the domino effect was going to be on everything else. And it took many, many quarters for the market to digest and understand the intertwined nature of it. And I think that that's what we have to be prepared for, that even if there is a lull in the overall volatility, that the overall investing environment is changing, and there are going to be signals that we're going to get that are going to be markers along the new journey that tell us how we have to position ourselves and where we have to go.
All right. Thank you, Ms. Gill, for sharing your views with us today. As Ms. Gill said, this year was quite unusual. And after 20 years focused on growth, the US investors are going to spend the next long period focused on inflation as a threat. That's all for today's show. Thank you for watching. See you.